Welcome to the deep dive. Today, we're plunging into, well, a document that might sound a bit dry on the surface. The Reserve Bank of India Annual Report for 2024-25.
Right, hundreds of pages.
Exactly. But trust me, this isn't just a pile of financial figures.
Yeah.
It's really a crucial roadmap, a detailed snapshot of our economic present and a big indicator of where we might be headed globally and right here in India.
Mhm.
So, our mission in this deep dive, we want to be your shortcut. Cut through the jargon, find those key insights, maybe some surprising facts, those aha moments.
Yeah, the ones buried on page 250.
Precisely. The goal is you walk away feeling properly informed, equipped, but without that, information overload headache.
And it really is a vital document. It's not just something the RBI puts out for fun. It's actually required by law, Section 532 of the RBI Act 1934.
Okay.
Yeah, it's the central bank's full account of its performance, its policies, its projections. It offers, well, unparalleled transparency into the financial health of the nation, really.
Okay, let's unpack this then. Starting big picture. What's the global economic scene looking like according to the report? What's the real takeaway?
Okay, so globally, the International Monetary Fund, the IMF, they're projecting growth at about 3.3% for 2024.
3.3. How does that compare?
Well, it's a slight dip from 3.5% in 2023.
Yeah.
And it's definitely below the historical average. We saw about 3.7% between 2000 and 2019.
Right.
And looking ahead, the projections are even lower, 2.8% in 2025, maybe 3.0% in 2026. So it suggests a more, let's say, challenging global environment for jobs, for investment.
And what's holding it back?
The report points to a few big structural things. Weak investment is one, slow productivity growth. That's a big one.
Why is productivity slowing?
Well, there are a few theories. Maybe the impact of past tech booms is wearing off. Aging populations in many countries means fewer workers, skill gaps, and then there's high debt levels, really high.
Like how high?
I mean, you've got countries like Sudan with a debt-to-GDP ratio over 250%.
Yeah.
Japan, the U.S., China, they're also high. Globally, public debt is heading towards maybe 100% of GDP by 2030.
Wow, that limits options, doesn't it?
Absolutely. It restricts what governments can do, their fiscal flexibility.
Okay, that global picture sets the stage. But there's this phrase catching attention. Disinflation, losing momentum. Sounds technical. What does it actually mean for, the price of things?
Right. Disinflation, it basically means inflation rates are still positive, prices are still going up, but the rate at which they're going up is slowing down, but slower than before.
Okay. So inflation is easing, but maybe not as fast as hoped.
Exactly. Global inflation did ease to 5.7% in 2024, down from 6.6% in 2023. And projections show further moderation, but, and this is the key takeaway, price pressures are sticky, especially in the services sector.
Services, like haircuts, restaurants.
Yeah, things like that. And that persistence is slowing down the overall pace of disinflation. What that means is central banks might have less room to cut interest rates quickly.
Which affects borrowing costs, economic activity.
Precisely. It all connects.
And amidst all this uncertainty, what about global trade? Are goods moving freely, or are we seeing more friction?
It's a mixed bag, really. Global merchandise trade volume, so physical goods, it actually expanded by 2.9% in 2024. That's a decent rebound from a 1% contraction the year before.
Okay, some good news there.
But the projection for 2025 is a small contraction, again, about 0.2%.
Yeah.
So there's volatility. Overall, goods and services trade growth recovered to 3.8% in 2024, helped a lot by strong services trade.
But there are headwinds.
Oh, definitely. The report mentions ongoing challenges, geoeconomic fragmentation, this country's kind of pulling back into blocks, left global integration, plus restrictive trade policies. And the U.S. dollar staying strong puts pressure on other currencies, too.
Right. So connecting this to the bigger picture, how are global leaders trying to, navigate these choppy waters? What's Brazil doing with the G20 presidency?
Well, Brazil took over the G20 presidency from India for 2023-24. It's actually quite interesting. They formed what some call a historic troika of global South nations, leading it Indonesia, then India, now Brazil.
A global South troika.
Yeah, and Brazil's theme is building a just world and a sustainable planet. They've set 3 key priorities that really tackle some of those structural issues we talked about.
Which are?
First, combating hunger, poverty, inequality. Second, advancing sustainable development, economic, social, and environmental. And third, reforming global governance structures. So a clear focus on systemic change.
Okay, so that's the global context, a bit challenging. Now, against that backdrop, India's story seems different, more resilient. What does the RBI report say about our own performance?
India has indeed shown remarkable resilience. Real GDP growth did moderate down to 6.5% in 2024-25 from a very high 9.2% the year before.
Still high growth, though, relatively.
Absolutely. India remained the fastest growing major economy. And this growth wasn't just one thing, it was driven by several factors. Improved consumption demand was key, especially seeing a pickup in rural India that suggests a broader recovery.
That's important.
Very. Plus strong net exports and a really buoyant services sector. Services grew by 7.5%, contributing almost 65%, 64.1% to be exact, to gross value added. That's its highest share since 2012-13.
Wow, so services are really driving the bus.
Increasingly so. It shows a strong structural shift. We also saw agriculture recover, growing by 4.6%, which is vital for so many people. The industrial sector, though, did moderate a bit, mainly due to a manufacturing slowdown.
Okay, let's talk inflation. Everyone feels that. What's the Indian inflation story according to the report, and how did the RBI respond?
Right, inflation. Headline inflation, the main number, it moderated to an average of 4.6% in 2024-25. That's down from 5.4% the previous year.
Okay, 4.6%. How about the components?
If you strip out the volatile food and fuel, what we call core inflation, that moderated quite a bit, down to 3.5%, and fuel actually saw deflation, prices went down by 2.5%.
But food prices?
Food remained a challenge. It averaged 6.7% inflation and even peaked near 10%, 9.7% back in October 2024. It did come down later to 2.9% by March 2025, but it was a significant pressure point.
And the RBI's response? The MPC.
So the Monetary Policy Committee, the MPC, they shifted their stance. They were in withdrawal of accommodation mode.
Which means trying to tighten things, basically. Soak up liquidity.
Exactly. They shifted from that to neutral in October 2024. So a more balanced approach, watching the data, not leaning too hard either way. And then, importantly, they cut the policy repo rate.
The interest rate banks borrow from RBI.
That's the one. They cut it by 25 basis points, 0.25% down to 6.25% in February 2025. That was the first cut since way back in February 2023.
So a signal that maybe the worst of the inflation fight was over, or at least pausing.
It certainly signaled a shift in focus, perhaps giving a bit more weight to growth considerations alongside inflation control. For you, the listener, that cut eventually makes borrowing a bit cheaper.
Makes sense. Okay, what about jobs? Amidst all these economic shifts, what's the labor market picture?
The unemployment rate actually held steady in 2023-24. Didn't go up, didn't go down.
Stable, at least.
Stable, yeah. But there were some really encouraging signs underneath. Both the labor force participation rate, the share of people working or looking for work, and the worker population ratio hit record highs.
Really? Why?
Largely driven by more women joining the workforce. That's a fantastic development, unlocks huge economic potential.
Absolutely.
We also see a continued rise in self-employed individuals, a trend since 2018-19, and the share of regular wage or salaried employees improved a bit to 21.7%, though still slightly lower than pre-pandemic levels in 2018-19.
Okay, those are positive numbers. But the rise in self-employment, sometimes that comes with concerns about job security, benefits, right? Does the report get into the quality of jobs?
That's a fair point. The report focuses more on the headline numbers and broad trends. It doesn't delve deeply into the nuances of job quality for, say, the self-employed versus salaried. However, it does mention ongoing efforts towards formalization of the economy.
Right.
And the idea there is that formalization over time should implicitly improve job quality, provide more security, regardless of whether you're self-employed or salaried. But yeah, it's mainly tracking the numbers here.
Got it. So with all this economic activity, how's the government's own budget looking? Fiscal health?
The government showed strong fiscal discipline. The gross fiscal deficit, the GFD, basically the gap between government spending and earnings, it declined. Came down to 4.7% of GDP in 2024-25.
Down from
5.5% the previous year. So like a household tightening its belt, moving towards a healthier budget.
And what helped that?
Robust tax collections, mainly. Gross tax receipts grew by 11.2%, and non-tax receipts were up over 32%. And importantly, they kept investing.
Capital expenditure.
It's exactly. Staying thrust on capital expenditure, building roads, ports, infrastructure. That grew 5.2% and was 4.0% of GDP. That kind of spending is crucial for long-term growth.
And they plan to keep that up.
Yeah, it's budgeted to rise to 4.3% of GDP in 2025-26. The overall targets are ambitious. Get the deficit below 4.5% by 2025-26, and bring the public debt down to around 50% of GDP by 2031. Strong signals on fiscal prudence.
Okay, switching gears a bit, India's been quite vocal globally on climate change. How does that show up in this RBI report? Are we seeing tangible action?
It definitely gets highlighted. India ranked among the top 10 high performers in the Climate Change Performance Index, the CCPI, for 2025. That's the sixth year running, since 2020.
Top 10. What do they measure?
Four things mainly: greenhouse gas emissions, renewable energy rollout, energy use efficiency, and climate policy. And the report notes that 2024-25 saw the highest ever addition of renewable energy capacity.
Mostly solar.
Yeah, particularly solar. Over 1 million households, 10 lakh installed solar panels under the Pradhan Mantri Surya Ghar Muft Bijli Yojana scheme.
The free electricity scheme.
Well, the rooftop solar scheme. It promotes clean energy and helps households cut electricity bills. Win-win. Plus, things like the eDrive scheme aiming for 30% electric vehicle adoption by 2030 show that focus on clean transport and lower emissions.
Right. Okay, let's talk about India's trade with the rest of the world. Merchandise versus services. What's the picture there? What's driving things?
Okay, trade. Merchandise exports physical goods they grew, but only just. Marginal growth, 0.1% in 2024-25. But that's better than the 3.1% contraction the year before.
So stabilizing. What about imports?
Imports expanded more significantly by 6.2%. So because imports grew faster than exports, the merchandise trade deficit widened.
The gap between what we buy and sell in goods.
Exactly. It went up to about US $283 billion. What drove imports? Things like gold, electronics, petroleum products. On the export side, electronics did well: engineering goods, pharma, rice, textiles, though petroleum product exports actually declined a bit.
But the overall trade picture isn't just goods, right? Services.
And that's where the good news story is. Net services, exports, what we earn from services minus what we spend, grew robustly, up almost 13%, 12.9%, hitting US $135.5 billion.
Driven by?
Significantly by software and business services. They grew around 14.5%. India actually kept its spot among the top 5 global exporters of commercial services.
So reinforcing that idea of India as a services powerhouse, not just manufacturing.
Absolutely. It's a key strength.
And speaking of money flowing in, remittances, India's position there is pretty incredible, right? Still number one.
Still number one. Confirmed as the top remittance recipient in 2024. Total receipts hit almost US $138 billion.
That's huge. But when we see such large inflows from remittances and services exports, does the report mention any potential vulnerabilities? Like, are we too dependent on these?
That's a great question. The report highlights how these robust inflows, services, exports, and remittances were crucial in cushioning India's current account deficit, the CAD.
Right, the overall international balance.
Yeah. Think of it like the nation's checkbook balance with the world for trade, services, income. These inflows kept the deficit contained at US $37.1 billion, which is about 1.3% of GDP for April-December 2024. So they act as a vital buffer.
So less a vulnerability, more a strength right now.
Exactly. It prevents that deficit from getting too wide. Now, in foreign investment, the picture was a bit different. Net FBI inflows, direct investment, they decreased quite a bit. And FPI, portfolio investment.
Stocks and bonds.
Right. Net inflows were way down from the previous year. And in fact, FPIs were net sellers for a chunk of the year, pulling money out between October 2024 and March 2025.
Any reason given? Global risk-off.
The report doesn't delve deep into FPI motives, but likely a mix of global factors, interest rate expectations, maybe some profit-taking. Interestingly, external commercial borrowing, or ECB's companies borrowing abroad net inflows, rose significantly.
So despite those investment shifts, the overall external position is stable. Reserves.
Very stable. India maintains ample forex reserves. US $668.3 billion at the end of March 2025. That covers about 11 months of merchandise imports, which is a very healthy buffer.
Okay, good to know. Now let's zoom into the RBI itself. From the nation's finances to the central bank's own books. How did the RBI manage its finances this year? What's the big story?
Well, the RBI earns money in a few ways. One key way is seigniorage.
Seigniorage? Sounds fancy.
It's basically the profit made from issuing currency. Think about the difference between the face value of a note and the cost to print and distribute it. Plus, they invest that money. They also earn from dealing in foreign exchange and, of course, interest income from lending to banks and holding government bonds.
Okay, and how did their balance sheet look?
It expanded significantly, up 8.2% to reach 76.25 lakh crore. That's huge, though as a share of GDP, it actually moderated slightly to about 22.8%.
What drove the expansion?
A big driver was a massive increase in gold holdings, up over 52%. Also rises in domestic investments and foreign investments. All this led to a big jump in total income, reaching 3.38 lakh crore, up nearly 23%.
And that income leads to the surplus transfer to the government, right, which was a record this year.
Absolutely. A record surplus transfer of 2.69 lakh crore, to the central government. That's a 27% jump from the previous year. Huge boost for government finances.
How was such a large transfer possible? Was it just the income or something else?
It was largely the strong income, but also related to how they managed their risk buffers. Specifically, the contingency risk buffer, or CRB. Think of it as the RBI's rainy day fund for financial shocks.
Okay.
They beefed up that CRB by about 1.13 lakh crore, taking it to 5.42 lakh crore. It's now maintained at 7.5% of their total balance sheet size. This follows a revised framework, the Economic Capital Framework, or ECF.
So they increased the buffer and transferred a record amount.
Well, the calculation under the ECF determined the required buffer size. Because income was so high, they could meet that buffer requirement and still have a very large surplus left over to transfer.
Right. But this buffer is 7.5% the right number. Is there debate?
Oh, definitely. It's a constant policy discussion. What's the optimal size for this buffer? A higher buffer provides more safety against massive shocks.
Yeah.
But
That money could potentially be used by the government now for spending on infrastructure, social programs.
exactly, it's a trade-off. Caution versus immediate economic stimulus. There's an ongoing debate about the appropriate range for the CRB and how it impacts the dividend paid to the government.
Interesting dynamic. Did the report mention liquidity in the banking system? Money sloshing around?
Yes, it tracked the shifts. System liquidity actually moved from a surplus situation, then into a deficit for a period, before returning to surplus by the end of March 2025.
And the RBI managed this.
Yes, through various tools. They reduced the cash reserve ratio, the CRR, down to 4% in December 2024. That alone released about 1.16 lakh crore into the banking system, giving banks more funds to lend. They also bought government securities, did currency swaps, standard liquidity management operations.
Okay. And on the banking front itself, how's credit growth looking? Are banks lending? And what about fraud? That's always a concern.
Bank credit growth stayed strong, definitely in double digits. It was led mostly by retail lending, personal loans, home loans, and lending to the services sector. Personal loans grew by 14.0%.
Healthy growth. Any difference between public and private banks?
One interesting point the report makes is about interest rate transmission. Private sector banks had a much higher share, almost 86% of their floating rate loans linked to external benchmark linked lending rates, or EBLR.
Meaning their rates adjust faster when the RBI changes its policy rate.
Exactly, faster transmission. For public sector banks, it was much lower, around 45%. So for you, the borrower, if you have a loan with a private bank linked to EBLR, you might see changes in your EMI quicker after an RBI rate change.
Good to know. Now, frauds, up or down?
It's a mixed picture again. The actual number of bank frauds reported fell, but the total value involved tripled to over 36,000 crore.
Tripled? Why?
Often due to reporting lags, banks were reporting old legacy fraud cases from previous years during this period. So it inflates the value figure for this year, even if the incidents happened earlier.
Okay, that makes more sense. Where are the frauds happening most?
In terms of sheer number of incidents, digital payments saw the highest count. Small value, high volume, often. But in terms of the value lost, loan portfolios accounted for the highest amount. Think large corporate loan frauds.
Yeah. Any other banking sector notes? Cooperative banks.
Yeah, urban cooperative banks, UCBs, showed improvement. Better credit growth, stronger capital positions, and lower non-performing assets, or NPAs. The RBI also tweaked rules for handling bad loans, like revised guidelines for asset reconstruction companies, ARCs, aiming to speed up resolution.
Okay. Let's shift from the banks and RBI operations to the broader impact on our daily lives. Digital transformation. How is that changing India's financial landscape, according to the report?
The shift is undeniable. The report highlights the currency to GDP ratio declining to 11.2%. That's a clear indicator people are relying less on physical cash for transactions.
And digital payments themselves.
Massive growth. Retail digital payments were up almost 18% in value and a staggering 35% in volume. Just huge numbers of digital transactions happening.
What about the digital rupee, the CBDC?
Still early days, but its circulation value surged up 334% to over 1,000 crore. It's still in pilot phases, but they're exploring interesting things like offline capabilities.
So you could use it without internet?
Potentially, yes. And programmability. Think of specific uses, like ensuring direct benefit transfers are used only for fertilizer or company allowances for specific vendors. Lots of possibilities being tested.
Fascinating. Any other RBI initiatives on the tech front?
Yes, they ran the Harbinger 2024 Global Hackathon, focusing on zero financial frauds and innovation for transformation. They also launched repositories, a fintech repository and an mtech repository, basically databases to track financial entities and the technologies they're adopting.
Keeping tabs on the ecosystem.
Exactly. And for data nerds, they launched the RBI Data app, giving access to over 11,000 macroeconomic data series. Pretty useful.
And financial inclusion, getting banking to everyone.
Efforts are ongoing through the National Strategy for Financial Inclusion. The FI Index, the Financial Inclusion Index, it grew to 64.2, showing progress. And a big milestone. 100% banking access within a 5-kilometer radius has now been achieved in 27 states and 8 union territories.
Wow, that's impressive reach.
It really is. Huge progress in getting basic banking services closer to people.
Okay, but this raises a crucial question. With all these rapid digital changes, new products, CBDCs, how is the RBI making sure people understand all this? Financial literacy, safety.
That's a key focus, and the report details some initiatives. They observed Financial Literacy Week 2025 in February, themed Financial Literacy Women's Prosperity, recognizing women's vital role.
Good theme. How are they getting the message out?
They've actually shifted away from celebrity endorsements, now using mascots like Money Kumar and M's Money for broader appeal. Seems more relatable.
Interesting approach.
And for kids, there's the Catch Them Young initiative. Tagline is RBI Keta Hai. Smart Bano, Cool Raho, with mascots Junior Money and Mini Money. They even ran an RBI 90 quiz for youth, trying different angles to reach different groups.
Makes sense. Any specific measures to help people access finance more easily? Small businesses? Farmers?
Yes. For micro, small, and medium enterprises, MSMEs, there's now a mandated 14-day turnaround time for banks to process loan applications up to 25 lakh for micro and small units. Should speed things up significantly for them.
14 days. That's quick.
It aims to be. And for farmers, the limit for collateral-free agriculture loans was increased from 1.6 lakh up to 2 lakh, a direct support measure.
Okay. And on the digital payment side, any user-facing improvements? UPI.
Definitely. UPI 123 Pay, the one for feature phones, its transaction limit was doubled to $10,000. And the UPI Lite wallet limit for small offline payments went up from $2,000 to $5,000. Makes these services more useful for bigger or more frequent transactions.
Making digital even more convenient.
That's the goal. Plus, the international push continues. UPI is now accepted in places like Bhutan, France, Mauritius, Nepal, Singapore, Sri Lanka, UAE. RuPay cards, too, are accepted in several countries.
Yeah.
And they're developing a global SFMS hub.
SFMS?
Structured Financial Messaging System. Basically developing a hub for easier cross-border payments using local currencies. All part of integrating India's payment systems globally.
What an incredibly insightful deep dive. We've covered so much ground. Started with those global economic currents, the headwinds.
Right, the context.
Then navigated through India's really impressive resilience, the growth story, explored the RBI's own finances, the surplus, the buffers.
The mechanics behind the policy.
And finally, looked at this fascinating digital revolution and payments, financial inclusion, and how the RBI is trying to keep everyone informed and safe.
Absolutely. And I think the core message, really, that comes out of this report is that India's economy seems well anchored, poised to remain the fastest growing major economy, thanks to sound fundamentals and pretty proactive policy, even with all that global uncertainty we talked about.
So, wrapping this up, what does this all mean for you, the listener? Well, hopefully it means you've got a sharper lens now, a clearer understanding of the big forces shaping our economic world today and tomorrow. That intricate dance between policy, markets, and, well, real life.
And maybe one final thought to leave you with, something to chew on. As India pushes forward on this ambitious path, sustained growth, more financial inclusion, how will that delicate balance, managing inflation versus fostering innovation, truly shape our journey towards becoming a global economic powerhouse in the coming decade?